John Greenwood and I have, as a result of the fact that the money supply, let's start at the beginning, the money supply, the stock of money measured by him too, is actually lower today than it was in July of 2022. So we've had a contraction in the money supply. That's very unusual, by the way. And with a contraction, you get, with a lag, lower and lower inflation. So inflation's being drugged down because of what happened, a year and a half, 2 years ago with the money supply starting to go south. So this lower PCE number of 2.5% is not surprising to me. And also, John Greenwood and I have the CPI, the Consumer Price Index, that headline number. We have it coming in by the end of the year between 2.5% and 3%. Right now, it's at 3%, the CPI. But they're coming down. The inflation numbers are coming down. And the main reason for that is, again, a year and a half ago, 2 years ago, the money supply started coming down. The year-over-year rate of growth in money supply is about 0.6%, about, roughly half a percent. And to hit an inflation target of 2%, you should be operating at Hanke's golden growth rate for growth rate in the money supply of about 5 or 6%. It's not only contracted and the stock of money is less than it was in July 2022, but this little uptick we've had for the last couple months on a year-over-year basis is peanuts compared to where it should be to be consistent with hitting the 2% inflation target. It's way below. I mean, it's less than 1%. The year-over-year growth rate should be 5 or 6. The CPI, Greenwood and I have it coming in around 2.5% to 3%. It's already at 3% and falling, so we're clearly going to hit the bullseye again using the quantity theory of money. Money is the fuel in the economy, and the changes in the money supply are what make nominal GDP go up and go down, depending on how fast the money supply is going up or going down. And what is the nominal GDP? It has two components, inflation and a real component. Broadly speaking, no. The big effect of this, if the Federal Reserve makes a profit, money is actually transferred to the government account. It's transferred to the government. So it's a source of funding for government expenditures. And if the Fed is making losses, that transfer doesn't take place. There's no money to send to the Treasury and the government's general account. So what's that mean? If the Fed would be sending profits and funds to the government's general account. So it's more of a fiscal effect than a monetary. Well, yeah, the Fed's a central bank. It isn't there. Central banks do and occasionally become insolvent, by the way. Well, I mean, that they can print their way out of the problem. It can happen, but, the printing press is always available. The loss per se. What concerns me is that the Fed doesn't look at the quantity theory of money. They have another model, and the model is a post-Keynesian macroeconomic type model. They have several, but those models don't include the money supply. The quantity theory of money, of course, does include the money supply. It's M, the supply, plus V, the velocity, equals P, the price level, times plus Y, the real rate of growth in the economy. So that's the equation of exchange that goes along with the quantity theory of money. And one of the variables, the money supply, changes in the money supply. If you add that to the percentage change in the velocity, it's percentage change in the price level plus percentage change in the real rate of growth in the economy. Inflation is not a global or a world thing. It's a local thing. Every country has its own central bank. Well, some countries are lumped together. For example, the Eurozone now, the European Central Bank functions as a central bank for those who are members of the Euro. But countries that have central banks produce their own money and that grows at different rates, and the inflation rates are different in the different countries. So John Greenwood and I have just looked at 27 countries around the globe that comprise about 75% of the world GDP. We call it a roller coaster, an inflation roller coaster from 2020 through this year, 2024. First, you get, in some countries, the ride has been wild because you had a big increase in the money supply, and of course that followed by, on average, you get inflation peaking out. So money supply peaks out, 24 months later, you've had inflation peaking out. Now that, I can give you the countries where that happened: US, UK, Eurozone, Denmark, Sweden, Canada, Europe and Canada, Australia, New Zealand, Argentina, Brazil, Egypt, Ghana, Mexico, Nigeria, Peru, Philippines, Sri Lanka, Turkey, Thailand. Those had a wild ride. The money supply went up rapidly, grew rapidly, and peaked out, and then on average, 24 months later, the inflation peaked out. So that's the wild roller coaster. The ones where you didn't get much of a wild ride were China, Japan, Switzerland, Malaysia, India, Indonesia, and South Africa, because they didn't goose the money supply as much. And as a result, the inflation did peak out about 24 months after the peak. It didn't amount to much. For example, the peak in China, to give you an idea, the peak rate of inflation that followed the peak rate of growth in the money supply was what? 2.1%. In China. I mean, right now, China almost has no inflation, by the way. This IMF thing, they add everything up, they aggregate it into some big aggregate number, basically meaningless, because the individual components of that depend on the individual rates of growth in the money supply in the countries, and of course the individual inflation rates, which vary all over the place. For some purposes, it's fine because, for example, commodities are very sensitive and they react much more rapidly than other components in the price index, whatever the broad price index, CPI or PCE, or the commodity part of it moves around and is quite volatile, and it will react more quickly to changes in the money supply than other parts of the index. The one that comes last is services. Services are the last thing to adjust. So all these things in the index, some of them come early and some lag way behind. Services lag way behind. But the overall index is important. That is the overall price level. And that is determined by what's been going on in the money supply. The point you just raised is key because they're looking at changes in relative prices. And commodities, like oil is a commodity. And oil price, it goes up and it goes down. The price level itself is kind of a separate thing. I mean, the oil prices are part of the index, and oil prices can be going up, for example, and everything else in the index going down. So the relative price is oil relative, or commodities relative to everything else. And that's not the way to look at aggregate price indices like the CPI. What's the CPI? Well, the CPI, it has over 300 items in it. It's a big basket with a lot of stuff in it. And some things are going up in the basket and some things are going down. Or they're going up and going down at very different rates. But the basket itself is, when we talk about inflation, we don't talk about specific things like commodity inflation. It's the big basket going up and going down. I mean, where's the big basket now in the U.S.? It's about 20% higher than it was at the start of 2020. And of course, that's why voters are so mad and complaining about inflation. The rate of inflation, the rate of increase in that aggregate is slowing down. That's what you and I just were talking about earlier. It's slowing down to maybe at the end of the year, 2.5% to 3%, according to Greenwood and myself. But the big complaint everybody has is that the basket itself is about 20% higher than it was 4 years ago. And of course, that's the gripe about Biden. People keep saying, well, you whipped inflation, it's coming down, but everybody going to the store is realizing it's a sticker shock. What you're buying is 20% higher. You're basically hitting sticker shock every time you turn around. The general point is correct, and that is the debt to GDP ratio is increasing. It's over 100%. And if you go to the nonpartisan Congressional Budget Office, you don't have to go to Elon Musk. Even go to these technocrats with sharp pencils on the budget, and they say, this is not sustainable. We can't keep doing this. And I agree, we can't keep doing this. So if something is not sustainable, my famous line, Herb Stein said, if something can't go on, it will stop. The question is, well, how will this stop? And there are only three ways to stop it. 1, rein in government spending. 2, increase direct taxes. 3, increase the inflation tax, or some combination of those three things. So that's really what Elon Musk is talking about. When he says bankrupt, he means, and something will change. Either direct taxes will go up, or inflation taxes will go up, or we will cut and rein in government spending. And how do you do that? I think the best way to do that is to have a constitutional convention and change the U.S. Constitution as they did in Switzerland. And we put in something like a Swiss debt brake, where government spending could not go up any more rapidly than real growth in the economy. Point number 2 in the Swiss debt brake would be that the budget over the intermediate term would have to be balanced. So it's kind of a combination of constraining government spending to the rate of growth in the economy and balancing the budget. Well, then you'll have some hodgepodge of a mix of those three things. Inflation tax, direct taxes going up, and government spending not being as reined in as a Swiss debt brake.